Welcome to the session, folks. Today we're diving into one of the big opportunities emerging over the next couple of years, especially in the realm of real estate and investments, based on some intriguing insights.
I'm all in. So we're talking about how elevated interest rates and market twists could create a chance to build fortunes?
Exactly. It's all about understanding that, despite the Federal Reserve's major rate hikes, some experts aren't seeing a recession looming. David Rubenstein, for instance, points out that his firm's data on hundreds of companies shows consumer sales staying solid, which suggests that the economy's footing might be more secure than many expect.
Right. And he even mentioned that his data is sometimes shared with the Fed, correct? That's quite an endorsement of the strength of current consumer spending.
Yeah, absolutely. Rubenstein emphasizes the enormous spending in sectors like hotels and restaurants. That sort of consumer activity creates a very interesting backdrop for seizing opportunities in troubled market times.
Yep.
It's like chaos in the market can actually breed profit if you know where to look.
So, if I got it right, he's essentially saying that in times of complications, like the ones we're witnessing, professional investors have their moment to make big gains?
That's the gist of it. Remember how he said, the greatest fortunes are made by professional investors when things are troublesome? It really underscores the idea that instability breeds openings.
Very true. And one specific area he highlights is real estate, right? But with a twist.
Exactly. It's not just any real estate. He's pointing to the office building sector, those large commercial properties that have taken a hit because of the work-from-home transformation. Essentially, as fewer people show up to traditional offices, those properties face declining values.
But isn't that a bit risky? I mean, office spaces might be devalued because of a shift that's not just temporary.
Good point. And here's where Rubenstein challenges conventional wisdom. He acknowledged that the office market is under pressure, no doubt. However, he argues that this very pressure creates a window. Discounted real estate debt for office buildings in big cities could be acquired at much lower prices. It's like buying quality assets on clearance when competition is sparse.
I see, but aren't there risks inherent in buying depreciating assets? What if the work-from-home trend persists longer than expected?
Absolutely, there's an element of risk. Yet, his view is that if you're positioned to hold on for 4 or 5 years, if you secure financing and manage the deal right, you might end up with a substantial payoff once the market adjusts. He's betting on the long-term rebalancing of the market, which historically has done wonders for long-term investors.
Makes sense, but I wonder if that strategy is only viable for very large, well-resourced firms. Aren't there challenges for smaller investors?
That's an astute observation. Rubenstein does talk in terms of professional long-term investments. However, he also notes another segment, single-family rentals. He cites insights from Stanley Druckenmiller about a structural shortage in single-family homes, and that's an avenue where even smaller investment amounts can come into play, sometimes starting from as little as $100.
Now that's quite fascinating, to think that while the office market might be in decline, the housing market, especially rentals, could really pick up steam.
Yeah, precisely. It's like a duality. On one side, office real estate debt in areas hit hard by work-from-home trends is available at a discount, and on the other, single-family rentals could surge due to the enduring need for housing, making them unexpectedly resilient in the market.
Right?
It's all about spotting where demand remains robust despite shifting trends.
So, essentially, Rubenstein's strategy here is to focus on assets that are undervalued because of market overreactions, but hold intrinsic value either in the long run or due to fundamentals like housing demand.
Yeah, that's a strong way to put it. He sees these turbulent times as an opportunity. If you're prepared to wait it out, you can secure assets at competitive prices, and eventually, those assets might rebound as the market normalizes.
And let's not forget the point he made about competition being reduced. Fewer players in these segments can make it easier for those who do enter to secure deals.
Exactly. It's kind of like going fishing in a pond. If there aren't many other anglers, your chances of catching a prize fish increase significantly. That scarcity of competition in high-quality long-term investments is a key element here.
It's sort of counterintuitive at first, right? Usually downturns make people run for safety. But here the idea is to capitalize on the opportunities that emerge precisely because everyone else is holding back.
Precisely. And to your earlier concern about risk, in times when markets are considered troublesome, only those with a strong understanding of these patterns can really thrive. It emphasizes disciplined, patient investing over knee-jerk reactions.
I'm a bit skeptical though. The potential for drastic market shifts is always there. For example, what about the possibility that prolonged remote work might make office spaces permanently less desirable?
I appreciate that skepticism, but Rubenstein doesn't say the market will stay static.
Yep.
He acknowledges that office space values will likely decline further in the short term as fewer people use them. The opportunity, though, lies in acquiring that debt at steep discounts. It's a strategy built on future market corrections.
That's fair. And his focus on long-term holding periods, 4 or 5 years, indicates a buffer period for the market to pivot.
Exactly. Think of it as planting a seed in rocky soil. It might take a while to see it sprout, but it could be a robust tree once it grows.
Yeah.
It's a perspective that requires confidence in eventual market recovery.
And what about the single-family rental angle? I really like that part because it doesn't just bank on office spaces.
Right, that's a very comforting counterbalance. With a structural shortage in single-family homes, as pointed out by Druckenmiller, renters will keep coming, and that creates a steady cash flow. It's almost like having a fallback plan if the commercial sector doesn't turn around as expected.
That versatility in strategy, diversifying across different types of real estate investments, seems like a smart hedge against potential economic downturns.
Absolutely, it's a layered approach. And in volatile times, diversification is sort of like your safety net. If one area falters, another might provide stability. There's an elegance in balancing risk by not putting all your eggs in one basket.
It also makes me think about how timing is crucial in these investment opportunities. You mentioned that well-prepared investors with long-term visions can really thrive. But isn't there ever a risk that the market could flip faster than expected?
Yes, timing is always the name of the game. Rubenstein's argument is that by leveraging precise data and long-term trends, one can make more informed decisions. He's essentially saying his firm's data shows consumer behavior remains stable, which is a counterbalance to fears of recession. It's a bit like trying to predict the weather in a climate that seems unpredictable. You prepare for storms by trusting reliable meteorological data.
That analogy is spot on. But still, it sounds like this approach really favors those who have access to deep data and insights, sort of an insider's advantage.
True, and that's where the professional edge comes in. However, the principle can still be applied on a smaller scale. Even if you aren't managing hundreds of companies' data, the general idea of seeking underpriced assets during economic transitions holds water. It encourages a more analytic, patient strategy rather than reactive moves.
I love that idea. It almost makes you rethink traditional investment fears that recessions mean inevitable losses. Instead, it frames downturns as windows for smart buy-in.
Exactly. It's a contrarian view, but one built on historical trends and sound reasoning. When market complications arise, they often clear a path for tremendous opportunity if you're patient enough to wait out the storm. It's a reminder that big change in markets isn't just about risk, it's also about the potential for reward.
So, if I were to boil it down, we're looking at 2 key areas: discounted commercial real estate debt, especially in office spaces, and an opportunity in single-family rentals driven by a structural shortage. 2 different sides of the same coin.
Spot on. Both sectors reflect different facets of market evolution. On one, you have a cautiously bearish outlook on traditional office spaces, which opens up a door for long-term gains. And on the other, there's a bullish, almost inevitability that housing needs and therefore rentals will remain strong.
With all these nuanced points, it really begs the question, Is now really the time to shift strategies, or should investors be cautiously waiting for clearer signals?
That's the million-dollar question. Rubenstein himself suggests acting when you're in a position to hold on for the long haul, meaning if you're prepared both financially and psychologically, it could be an ideal time to step in. But it's definitely not for the faint-hearted. It demands rigorous due diligence and a strong stomach for market fluctuations. It sounds like
Yeah,
this isn't a casual dip-in strategy, but a calculated long-term play.
and I guess that's where professional insight and a methodical approach outweigh the hype of immediate returns. It's a stark contrast to the short-term trading frenzy we often see.
Exactly right. It's about understanding market cycles and preparing to pivot when the time is right. Knowledge, patience, and a willingness to tolerate short-term instability in favor of potential long-term rewards, those are the hallmarks of this
Yep.
strategy.
Well, this has been an eye-opener. Turning market complications into opportunities really gives a whole new perspective on investment strategies.
Absolutely. Whether it's embracing discounted commercial debt or capitalizing on the single-family rental boom, the key takeaway is to look beyond immediate market fears and consider the long-term potential.
Thanks for walking through these insights. It's always refreshing to get into the nitty-gritty of market strategies and see the hidden opportunities.
Cheers to that. And as always, keep your eyes on the data and your strategy agile. It might just be the best move over the next couple of years.
Indeed. Here's to navigating complexity with confidence and turning challenges into real opportunities.
Thanks for tuning in, everyone. Until next time, keep questioning and investing smartly.